Hello everyone, welcome to our follow-up video number 2, showing some examples of the kind of thing we might need to do for our homework for chapter 1, job costing. So here's our problem. Manufacturing overhead allocation and calculating cost of job pyramid expects to incur $3 million in manufacturing overhead costs this year. During the year, it expects to use 40,000 direct labor hours at a cost of 600,000 and 80,000 machine hours. Okay, so the first thing it asks us is to calculate predetermined overhead rate based on direct labor hours, direct labor costs, and machine hours. Now, in real life, you would, at least in a typical job cost scenario, we would do this one of those three ways. Okay, not all three. All right, and certainly not with using the same manufacturing overhead costs. So we've estimated, we've got our total manufacturing overhead cost, and they're asking us to look at three possible scenarios on what the right activity rate might be. Okay, and again, there's not a right answer. There's maybe a better answers and so forth. So we're going to take our total fixed costs, total manufacturing overhead costs. They could be fixed and variable. Okay, and divide by the direct labor hours first. Okay, so we want to label that. Okay, that is per direct labor hour. And we'd like to label that right because when we have multiple jobs, multiple things going on, it's really easy to lose track of. We don't want to just say per hour because that could be machine hours. Okay, when we get later in the problem and we're trying to look back and see what we did. Okay, so the next one that we are going to use, we're going to still take that same $3 million and divide by the 600,000. So this is $75 per direct labor hour. This is $5. Okay, doesn't have a dollar sign on, but it's $5 per dollar of direct labor. So for every dollar you spend on direct labor, you have $5 of overhead that you would allocate to that job situation. And then the last one, okay, is machine hours. Okay, we'll take the 3 million and divide it by 80,000 machine hours, and we get $37.50 per machine hour. So we're going to either use one of these three, okay, to calculate this. Now, a couple things. First of all, you've got to track direct labor hours and direct labor cost anyway because you got to pay your people, right? That's not a good enough reason to use it, okay, but it is something to think about. If we're going to use machine hours, we have to be able to count machine hours. Our machines have to have some way to tracking how many hours they use and some way to figure out that by job. So that when you start the machine working on a particular job, you program in the job number or some code that indicates that job, and it keeps track of how many hours. And that's just not that tough of technology in today's world, but we need to make sure that we have that capability, or machine hours isn't, a usable thing. Okay, we can't just know the machine hours in total. We need to know them by job to be able to do that. So if we were looking at the cost of this job, okay, you would have the direct materials and we were given some information about some particular job, 6,000. The direct labor would be 4,000, and those two numbers wouldn't matter whether you're using direct labor hours or machine hours, right, to allocate overhead. But when you get to overhead, it would depend on what you had decided to use as a predetermined overhead rate calculation, which one you're going to use. So if you decided machine hours, then you take the 700 machine hours that you can actually track to that job and multiply, okay, by machine hours. That's why you need to have that labeled so you remember, okay? And so our total cost of this job would be the 6,000 plus the 4,000, those direct costs, plus an allocated amount for overhead. Now, if we did it using direct labor hours, our direct materials and direct labor would be the same, right? But instead, we would use, okay, our number of hours, okay, which was 300 hours, right? See, they used 200 that got paid at 15 and 100 at $10. Okay, that's 300 hours times the 75, right, that we calculated the predetermined overhead rate. And you see that this is an estimate, right? So these two estimates are different. Okay, and it's really based on which one of those is the better measure of the overhead type activities and costs. Because you could answer how much does this job cost two different ways, $36,250 or $32,500. And in reality, you would be right either way because we don't know exactly the overhead. We have two possible ways of estimating, and maybe we look at that after the fact and kind of see which ones seem to capture that, and maybe we can't even tell for sure, and maybe we just have to do it for some period of time before we can actually generate the information we need, okay, to know which of those two activities. But for the time being, we got to go with one or the other in terms of our scenario here to come up with a cost for that job. Now, to illustrate what we were talking about earlier in terms of what I call the flow of costs, okay, if we use T accounts to illustrate what's going on, when I purchase raw materials, that's a debit to the raw materials T account and a credit to accounts payable, wages payable. Right? That's how that would be recorded as we buy things. These are things that go into the warehouse. We don't know what job they're going to get used at right now until we pull them out. Okay? Now, of course, raw materials might have a beginning balance. All of these could have a beginning balance, something that's already there left over from the last accounting period. Okay? Stuff that's already in the warehouse before the beginning of the month or whatever. But that's what we would change. Then when we use direct materials, okay, we don't use any direct materials without identifying what job they go to. So we go to that job and we debit that job's work in progress, whatever term you want to use, T account. So that would be the same amount, what we used here, okay? If we use indirect materials, we'll call it indirect materials, all right, that would go in factory overhead because we can't identify what job it goes to. That's the definition of an indirect material, can't identify the job. Okay. Now, when we do direct labor, okay, again, they're writing down or using some computer system to keep track of what job they work on. So their direct labor is going to go to that job, right? And then we owe that employee, okay, the direct material, labor, I should say, direct, not DL. So that would be the same. And then when we have indirect labor paid, that can't be identified by job, but we still have to pay our, owe our indirect labor. Okay. And of course, you'd be doing this multiple jobs simultaneously. So I just showed it in job A, okay, but you would be doing the same thing along with job B or job 3 or however you identify each individual jobs. You may put your customer name right on the work in process, the account number. You could actually use that as the account name, the customer name. I've seen that used much all the time. And okay, as you go along, there's going to be other, okay, indirect costs, all right, that are going to credit to factory overhead and credit either cash or, okay, accounts payable. And then at some point, either at the end of the month, end of the year, or when we finish the job, however we choose to do this, okay, we're going to allocate overhead. That's going to be a debit to this job, and each job for that matter, okay, and a credit, okay, to factory overhead. So if this job was job A that we just did up here, our direct materials used would be 6,000, our direct labor would be 4,000, and the allocated overhead would be either the 26 or the 22, depending on which one we had chosen to use at the beginning of the year. And you'd have 3 costs there: direct materials, direct labor, and overhead. Like we talked about in the slide presentation, there's always 3. Then when I finish with job A and I know that I've recorded all of these, okay, then I credit the total cost of the job, right? That's going to, this credit's going to equal the total of all the debits. So even if this job took 6 months and we had a whole bunch of direct material used, a whole bunch of direct labor, every 2 weeks we have more hours, okay, and we allocated overhead at the end of each month, okay, so we had that all taken care of. You would add up all that total. It could be 3, it could be 6, it could be hundreds. That total cost, okay, and now it's finished. It's going to go down in finished goods. That's the debit, credit there, right? Then when I sell job A, then I'm going to have the total cost job A move to cost of goods sold when I sell it. And then the amount that I sell it for is going to be a credit and debit accounts receivable, or if they pay cash, we could put it directly into cash. Okay, that is the thing. And these work just like any T accounts. You total up the debits, subtract the credits, that sort of thing. Okay, to get your balance. And then for your income statement at the end of the year, you're just going to add up the sales of all the jobs, add up the cost of goods sold of all the jobs that were sold. And that's going to be a big chunk of your income statement. And then, of course, these raw materials, work in process, finished goods go on the balance sheet as inventory. And then you have a liability here and an asset here as accounts receivable.